Thanks for tuning in to Talking Point. I'm your host, Niraj Shah. The case for a chat, well, multiple things, both global and local. Remember, key data from the US comes out later today and the FOMC meet slated for next week. It may be a non-event, but it is there. There is fair degree of geopolitical news flow as well. And in the midst of it all, of course, we will talk about the post-budget outlook with our guest. We will talk about whether defensives are coming to the fore, or is it still a growth-oriented investment strategy? Our guest today, Sridhar Sivaram, Investment Director at Enam Holdings. Sridhar, so good having you as always. Thanks for taking the time out. No, the pleasure is entirely ours. Sridhar, just before we wade into other things, the Indian bond markets, the Indian currency markets, the rupee has been hitting new lows almost every single day, last 2 or 3 days. Bond yields also in a swift move scenario. What's happening with the Indian macros?
So see, if you see relative to other emerging markets, you see India has been, our currency has been the most stable currency within emerging markets. Even look at say something like Korea or even Taiwan. India has been relatively very stable over 18 months, I would say. So I think some bit of what is happening with DXY, Japanese yen, so I think some bit of course correction is happening. There's been a rate cut in China, and that has an impact on the currency there. So I think there are a lot of moving parts here, but I would say that the currency markets have been very stable. The bond markets also have been reasonably stable. I mean, you know, there'll be some ups and downs on the bond market based on, you know, there were news about the inclusion in the MSCI. Then there were some adjustments based on the budget when the borrowing numbers were reasonably stable. So I think there are a lot of moving parts, but I don't see any worry here as we speak.
Yeah, no worry. But the fact that the 10-year bond yield is currently at the lowest, I mean, 6.93 is the last tick that I saw. Is this a sign of buying because of this emerging market inclusion piece and the fact that we've bettered the fisc deficit glide path targets that we had set for ourselves in FY25? What's leading to this?
I would say a combination of both. So I think the fiscal deficit, if you look at the absolute fiscal deficit, and that's what I look at, has been lower for the last 2 budgets. So it's not the percentage, it's not the optics, it's actually the actual number is lower. And we've been guided below 4.5 for next year. So I would assume at least 4.4. So I think the glide path looks extremely good. So obviously it means that the absolute borrowings would also come down from the government. So I guess it's a combination of all these factors. Plus there is a hope that, you know, in possibly 9 months' time, we'll start to see some sort of rate cuts to happen. I don't see it happening immediately, but once say US starts cutting rates, we are seeing, as I said, China has been cutting rates very aggressively. And once US starts to cut rates, there'll be some pressure to normalize the differentials. So I guess these are really complex macro, frameworks that we are seeing right now. I mean, who would have thought 50% depreciation to yen and nothing happened to global markets? So I guess these are the new age of, you know, digesting news every morning and trying to figure out, how to interpret some of these. But I would say broadly, Indian macro looks good. I do not have any worries. I think the central bank has done a reasonably good job.
Okay. And just a word, since we are on the topic of rate cuts, I mean, the fact that the US GDP numbers have looked so solid, while there is an FOMC meet next week, etc., do you foresee one and done in terms of rate cuts from the US, or even that is difficult to call?
See, I'm not an expert on US, but when I speak to my, ex-colleagues in New York, the sense I get is that we'll at least get 1 and possibly 2 this year.
Okay.
From where we were, I mean, you go back to say early February, there was expectation of 3 or 4 cuts. But as we've seen that inflation has been sticky and the path to below 2% for US is looking as difficult as it is below 4% for India.
Yeah. Okay. Fair call. So India macro is okay. The correction in bond yields, great. There must be flows. Rupee, no problems at all. What about the budget math? And, if we strip out the capital gains part, and I'll talk about that as well, But if we strip that out, and I'm not saying you are negative because of that, but I'm just removing that right now. The other provisions, the other things that have happened, you thought the budget was fair and square, or did it leave a bit to be desired?
No, I think I was very happy with the budget from an overall standpoint, because one, the fiscal glide path, which is what I give more importance to, because that's what makes a difference to the macro numbers in the overall scheme of things. That looks extremely good, and I know that even the next year they're committed to 4.5 or below. And then I look at the capital expenditure number. It's a growth of about 16-17% from where they were last year. And keep in mind that there's only that much you can do. These are not things like you're just not distributing money. This is actually into hard assets, and these take time. So I think within the constraints that they have, this is a reasonably good number. And at some point, private sector has to take up the mantle of this whole capital expenditure bogey, which we haven't seen coming from the private sector. Hopefully, it will start to come. And
you think it will?
Sorry?
You think it will? Because you must be talking to corporates. We're talking about rate cuts not happening soon.
Early signs that it will. I mean, in some cases, I know that they were waiting for the new government to come. Okay. Now that has also happened. In a lot of cases, we are seeing capacity utilization already reaching a stage where they will have to put private capex. And I think if you go back to the 2003 to 2007, or even the period, say 11 to 14, I think the power sector took a large, percentage of the private capex. I'm seeing a revival of the power sector in different forms. May not be in thermal, but you see in all the renewables. So India is adding significant amounts to power, and we are also seeing capex because of increased demands from manufacturing because of exports. But these will take time. But I think it's happening. So coming back to budget, I think if I look at capital expenditure, I do not have any issues. There's been some boost to consumption by giving more money in the hands of people, by pushing people into the the new tax regime, and the stress on employment. And we'll have to wait and see how it works. But at least there has been an attempt to incentivize employment. And my view on employment has been slightly different. That actually the center cannot create employment. They don't set up factories. They don't set up call centers. It is the state which has to do. The center can only facilitate. And have they facilitated in the last 5 years? If you ask me, the question is yes. And there have been states which have done very well in employment. You look at, say, Andhra, Telangana, Tamil Nadu, Karnataka to a large extent, till all this news that has come now. So it is the state that has to do, and I think the center has done a reasonable job. I really don't understand why the center is taking the responsibility for employment. You can't generate employment. You can only facilitate. Be that as maybe they have done a good job of trying to facilitate, with all the 3-4 schemes that they've announced. Yeah. So overall, I have no complaints within the constraints. I think this is a reasonable budget.
Political compulsions, maybe, Jeet. just the way the conversation
and we also expect too much out of a budget. Keep in mind that indirect tax is totally out. So what we are left with only direct tax. Even in direct tax, broadly, everything is known. So I think there's only that much to expect from a budget.
What was not known was this uptick, right? Now, what do you make of it? I mean, I've heard two ends of the same coin from equal participants. The relief that I thought was that on the budget day when I was anchoring, I thought that, this opens up the door to some uncertainty. But I think they've made some clarifications that they're not thinking of further increases, quote unquote, for now.
So I'll tell you how I have rationalized this. Most participants in the market were expecting this for the last 18 months. That rationalization of the definition of long term is going to happen. The previous finance secretary on his exit interview actually made it public that this is being discussed. If you ask me, I was expecting this in February. What has come is possibly 6 months earlier. But we were also expecting that the short term could go, the definition of long term could move to 24 months. And as a result, what has come is slightly better than what most participants were expecting. That your equity long term stays at 1 year, and your short term has gone up, and your long term has also gone up by 2.5%, which may not have been expected. in the overall scheme of things, I think the certainty that broadly this stays for the next 4-5 years is also quite positive. And that's how I would, rationalize this. Higher taxes never good. But having said that, when you look at the percentage of people who contribute to the tax, it is abysmally low.
Yeah.
And I think the community which invests in the market, I think can pay a little more tax.
But it's growing, right? Well, one is that, two, I mean, okay, so the counter, Sridhar, and before we take that break, because I would love to talk about portfolio positioning on the other side, but just one more thing, the counter that some people are giving is that you don't want, it's a bull market that is doing very well. We have divestments or some divestment of assets, if not companies, and listings, etc., depth of capital markets. Does that get hurt also from a foreign investor's perspective? And while LTCG may be at line with global standards right now, or maybe lower than that, but global markets don't have a whole host of other taxes, STT, etc., that Indian markets have.
So when I look at the markets as we speak today, it doesn't look as if the market's very unhappy.
That's true.
Even on the day of the budget. So we did make representations to the finance ministry that if you do anything like this, it'll have a very drastic impact on the market. And today we are looking very stupid when we when we go there next time. They'll say, "Hey, listen, you said this, and this is what has happened in the market. So you guys are clueless." But having said that, I would still say that the number of people who file for returns and the number of people who make any substantial gains, and there are some data floating around on this, is still very abysmally low of people who are making even, 5 lakhs of profit out of stock markets, the reported ones.
Yeah.
They're abysmally low. So I think the evidence that almost 80% of the tax is paid by 0.3% of the filers.
Filers, actually, not even the
so
populace.
it's a drastic number. So point I'm making is that what you're saying is that the market's evolving, there are more participants coming. The taxation side hasn't still seen that.
Okay. Sridhar, we spoke a fair degree of what the budget math and the global macro might be like. Trying to understand if the portfolio strategy changes in any fashion post-election, post-budget.
No, I don't think the portfolio strategy changes. The budget was broadly an extension of where we were, barring, say, a little bit of push to consumption. But I don't think that makes a massive difference to the listed consumption space. And I think broadly it remains the same. I mean, I think incrementally the market's becoming more and more a bottom-up market than a top-down, because within each sector, some of the stocks are trading at fair value or above fair value. So it becomes difficult to take a really top-down macro call and buy anything. So individually, you'll find good stocks. Maybe 1 or 2 sectors here and there are looking good, but even there, everything is expensive.
Okay, so where is it that within the here and there, things are looking good? And then we'll talk about the valuations thereof, of course.
As I said last time also, power sector is something which we're very bullish, because we are seeing one push from the government. 2, India's underinvested in power in the last few years. And incrementally, as I see newer industries emerging, be it data center, be it EVs, all of this will require more and more power. Plus the normal demand for power. So we are going to see push to wind, solar, all the renewable energy, plus for thermal also. So we would be adding 70-80 gigawatts of thermal power over the next 4-5 years. We'll double solar in the next 3-4 years. Double thermal wind in 3-4 years. So obviously there's a lot of activity that is happening in this segment. How we play this is look at the equipment providers, because that's a far better way of playing. Utilities also will have their own role to play. So I think this whole gamut looks very exciting. But having said that, a lot of the stocks have run up. We've been speaking about this for a while now, but earnings have been very good. Guidance for the future earnings also have been extremely positive. So if you take a 2-year view, then possibly they look reasonable. but this is an exciting space.
Yeah.
Financials is the other we like. I mean, but we've seen some headwinds from the from Reserve Bank from time to time. We saw one yesterday. A combination of PSUs and private both. I still like a few PSU banks where credit costs are not very low. So there's still some room for credit costs to fall. As a result, profits can continue to go up for the next few years. And private sector hasn't done anything for a while. And I'm hoping that, in my view, there's one more pain quarter, the next one, and then things should normalize. So this is a good time to accumulate the private sector. Financials in general, especially the banks, is my preference, not the NBFCs.
Okay, and sorry, just so follow up on both, but the banks first. Will the bank good times be a result of a base effect or upping because of maybe the private sector capex cycle restarting and therefore corporate borrowing happening, or will it largely be retail facing, consumer focused financials which will come to the fore? How do you see the pie?
So I think it will be a combination of multiple factors. One, of course, is the base effect itself. Two is the fact that I would expect some moderation in the rate cycle over, say, the next 9 to 12 months. And as that happens, even if the RBI doesn't cut the rate, it just increases the liquidity. The deposits conditions that we are facing right now can improve a lot. So if that happens, the scramble for deposit that we are seeing right now can improve. That helps the margin. Private capex, of course, because if you look at most of the private sector banks, they're almost now retail banks. They're almost 60-70% is retail lending from where they were in the past. So I think that factor also does play a role. Plus the valuation itself, the fact that you're not buying these banks at 4 and 5 times price to book. Even at these earnings levels, the ROAs and ROEs are still very attractive. It's just that the earnings growth momentum has sort of taken a back seat. So they from, say, 18-20%, they are now at, say, 10-11%, in some cases even lower. So that has been the challenge.
So this whole LCR thing, and you mentioned that RBI actions or regulatory actions, not just RBI in case of non-lending financials, even SEBI actions, have been fairly regular. Just this morning, this discussion paper on higher LCR necessary, that's a short-term dampener, you reckon? The bigger picture is still northwards.
Yeah, I think what RBI is doing is a step in the right direction, nudging banks to, look for deposits rather than other ways of finding liabilities. So I think I would support RBI and whatever they have done till now. The only thing I would look for is signals from RBI on liquidity, because that's something they can manage better. Because if the government doesn't spend, like this year, the government spending has got delayed because of elections. So we've seen, the liquidity conditions a bit more tighter than what you see normally. So those are the things but they do manage these short-term liquidity much better. But we are seeing a scramble for deposit. Most banks have increased their deposit rates. So which is sort of indicating that, you need to, fight for deposits.
Got it. Okay. Just one question on the first part of your answer, which is the power space. Now, from the time that we first spoke about it, right, the utilities, I mean, there is a note from Morgan Stanley on one of the companies today. I'm not asking you to make a company-specific comment, of course, but they are talking about some reasonable upticks out there too. But from the time that we first spoke, the prices and the valuations of these companies have moved northwards quite a bit.
Yeah.
Are they still attractive based on a 2-year, 3-year time frame, or should people be wary of the valuations and look for downticks? Are these a buy on dips, or are these attractive even now for you?
Yeah, so I would say as a investor who looks for value, I would say buy on dips.
Got it.
But if you take 2 to 3 year view, there is a lot of value. They'll show a very strong earnings growth. I mean, you're talking of north of 30%. Now, so if you push it by 2 years, they look better. If you push it by 3 years, but difficult to project 3 years. So I'm not, getting into that territory. But every year you get 2 to 3 days of buying opportunities, and you have to be ready to, pounce on those days. So you have to do your homework and be prepared. But the space is looking very exciting, and there are newer opportunities coming every day.
Got it. One word on a sector which is starting to sulk slightly after having 4 heady years, autos. There's a bit of a wrinkle on the banana peel out there for specific pockets within autos, and a wide bucket out there, 4-wheelers, 2-wheelers, EVs, auto ancillaries. How do you think about this space?
So I think this space is getting disrupted by EVs. So two-wheelers surely getting disrupted. Look at, we'll have an EV listed in the market very soon in Ola. So we'll start to get more numbers on a regular basis. But this space is getting disrupted. So I would be very cautious because the multiples that we are giving today for an industry which is getting disrupted is fairly high. And I'm not saying that the traditional autos become zero. I mean, they will coexist, but it's just that the growth rate that we were getting, already if you take, say, last 5 years growth rate or a 10-year growth rate, they're not in the high teens. They are in the single digits in most, categories. I'm not saying companies here. So if you take two-wheelers as a category, you take scooters as a category, or take passenger vehicles as a category, the industry has grown at single digit. So, and within that, if EVs are taking a share, then the pressure on the others continues to increase. So I would be cautious. I would prefer the auto ancillaries because that's where you have a bit more headroom for growth. Irrespective of what happens to the industry, you still need the ancillaries to provide, because most of these companies are actually assemblers. They don't actually manufacture much. They just assemble everything.
Okay, Sridhar Sivaram, before we let you go, quick 30 seconds. Last time you gave us a tourism nugget, a book nugget, or an article nugget, or a website nugget.
Actually, I don't get time to read books.
Oh, okay.
So because I have so many other interests to pursue, and most of the time I'm reading balance sheets and research reports. So I prefer to watch videos, podcasts. Okay. So those are
any good podcasts before we wrap?
I like the Smita Prakash podcast, the ANI one, because she gets very different variety of speakers, and they're fairly detailed. Okay. So it has one on Bhavish also very recently, and I found that very interesting. You get to understand a person far more when you listen to a 1-hour podcast. And you can watch it at your own, pace. Sounds you can good. Increase the speed. So you can use. So I prefer to listen than to read, because I also travel a lot. I watch movies in I speak 5 languages, so I watch movies in 5 languages. So I really don't get time to read. That's how. Honest admission that I'm not in the book space.
Doesn't seem like it usually, but okay. But the podcast one is a good one. So thank you so much for that nugget, Sridhar. And great talking to you as always.
Thank you. Thank you for inviting me.
No, the pleasure was ours. And viewers, thanks for tuning in to this edition of The Talking Point.